Hello everyone, welcome to another edition of our Trader Talks videos with myself, Richard Perry, market analyst at Hantech, and also Steve Miley, the market chartist. Welcome again, Steve.
Hey, thank you, Richard. Good to be here.
I hope you're well, Steve.
Yeah, well, yourself all good under lockdown?
Yeah, still going. Kids still not at school, but hey, we go. We're still going to get through it, I hope. So, okay, well, we're going to be talking about some trading ideas. We're going to be going straight into those this week. We're going to be looking at the S&P 500, some good ranges and a potential breakout going on there. Similar sort of looking move, I think, on Aussie yen as well that we've got to be considering. Now, also, when we're talking about the macro fundamentals, we're going to be looking at how these ranges are going to be playing out. We've got interesting ranges for the treasury yields and also dollar index potentially coming through there. So how these equity markets react to these ranges is going to be important, but we're also looking at a little bit of strength coming through for the euro, something to keep an eye on. But also in terms of the data front, how the how the May data is going to be affecting markets and sentiment. So let's get on to some of these trading ideas.
So, Richard, let's start off by looking at the S&P 500 in here for our first trading view and our trading idea. And for me in here, we had this kind of head fake double top pattern. We had that peak up at 29.65. We got another peak just below there last week, and the market then dipped down to that 27.60 level, confirming a double top pattern. We've also reversed down through that 13-day exponential moving average. It all looks a lot more negative in here. The bears were having a field day, looking for the more negative theme to come through at the end of last week. And then Monday, everything gets turned around.
Well, don't bet against the Fed, do you? Do not bet against the Fed. Powell came through, and certainly markets have responded, haven't they?
Yeah, so markets responding, as you say in there. And then obviously we get the double bonus in here of potentially a vaccine. There's some positive tests on that, alongside the fact that then the EU recovery fund looks like it's going to be up and running. Macron and Merkel pointing towards progress on that. So kind of all of that, accommodative Fed, as you say, don't bet against the Fed. Hopes on a vaccine alongside EU recovery fund, sending stock indices surging back on Monday, and we went back up and took out that 29.65 peak Monday.
Yeah, I think that level is key. 29.65, sort of closing above that, I think would be the key breakout if it were to be seen.
Yep. And so now we've had that little pop above there, as you say, not quite managing to hold, but then prodding back higher as we speak in here this morning on Wednesday. So for me, we've kind of had it's more the rejection of the bearish sentiment rather than the actual bullish signal so far. We've still got some more work to do, and actually get and hold above that 29.65 old high. But should we get through there, then you're zooming up to psychological 3,000, option target at 3,000. And then you've got that important peak that comes back from March up at 31.37, that acceleration peak. That's a potential target in the next 1 to 2 weeks, potentially, if we get a fear of missing out rally.
Yeah. I mean, if you do see that closing break above 29.65, for me, that's a consolidation rectangle breakout, and you can imply the measure of around about 200 ticks higher from that if you take that as a rectangle. So we could see some further upside, certainly in these equity markets. I think for me, it's still a slow burner. I think the markets are still struggling to really take the bull by the horns and go forward with it. But I think ultimately, as you say, don't bet against the Fed, and I think that is a real issue that we've seen over obviously recent years, but in this recovery as well, how markets are responding. But certainly looks to be more positive again, and holding that breakout would be key, I think.
Sure.
Yeah, okay, thank you, Steve. Well, for me, my chart, I think, is very similar actually to this. I think if you look at the Aussie yen, we're looking at some very similar style of moves where you've seen this ranging move over the past few weeks. I mean, you could even argue Aussie yen breaking out above that 70.15 level is a key moment. Does this now mean that equity markets are going to be following? Because it certainly is that risk recovery that we've seen through markets, and perhaps the Aussie is leading the way. The yen is a classic safe haven, and breaking above that 70.15 level, holding that uptrend. 68.50 is a key level on the downside. For me, my perspective, I'm looking at buying that breakout level now on the little unwinding retreat, the pullback. nice support band, 60, 69.75, 69.50, maybe up to the 70 figure mark. I think that's a little buy zone, and I think that you'd be placing stops under that 68.50 mark for playing the continued rally.
Yeah, agreed on that. I mean, I think what's really impressive is that rebound right off that trend line that comes across from March. The market went right down, sat on it, and then you get the big impulsive move off of that back on Monday, and takes us to a new multi-week, multi-month high, in fact, in here. And we're not far off now, getting back to the March and the February peaks from where pre-COVID days, right? Before it had moved into Europe, before it even moved into Australia. So the markets are certainly reacting very, very positively. The FX space, as you say, they're maybe leading the equity space to the upside with this risk on move. And as you say, Aussie yen, the classic risk proxy in the FX space. So and I think all the kind of the trade suggestions you outlined there, very much I would concur with those, the buy zones. And then below 68.50 is a game changer on the downside, but at the moment certainly upside. What's your view? Upside targets?
Yeah, upside targets. You've got once more, I talked about the range that we've got on the S&P futures, similar sort of range really. You can imply around about 250 pips of upside, and that leads you into that 72.40, 72.50 area. I think that is very realistic. That is the old sort of support that you had from January, February time. So I think that a return to that sort of area could easily be seen.
Sure. Let's talk some macro, yeah?
Yeah, good idea. Well, with these macro moves that we've seen in recent weeks, we've not really seen any real sort of conviction, I think, in markets. And it's interesting that we've got ranges that have developed through treasury yields. I mean, I always like to look at the 10-year treasury yield, and what we can see is that treasury yield has broadly there or thereabouts been ranging between sort of 55 basis points up to 80 basis points, little real direction. And also, if you look at how dollar index has gone as well, similar sort of moves really between 98.50 and 101 on that dollar index chart. So again, lacking conviction in some of these major markets. But it'll be interesting to see if the equity markets get, as we sort of focused on earlier, get driven out by some of the more riskier end of those Forex moves, the Aussie yen chart being that classic one that we always look at. So how those equity markets respond, I think, in the coming days to certainly the more developing accommodative theme from the Federal Reserve is going to be important.
Yeah, I think, they are interesting, the ranges that you're seeing in some of these other markets, particularly with those US Treasury yields. It's almost like the Treasury yields have already adopted the belief of like yield curve control. They've kind of not actually said we have yield curve control, but we're not far off of it really from the Fed. So, and with that basis, it means that, yields are staying, very, very low, even with equities going higher. We're not seeing bonds sell off to new low prices and higher yields. So bond yields staying low, reflecting that accommodative policy, which for me then spurs on that risk move, right?
Well, agreed. I mean, it also sort of restricts the dollar as well, doesn't it? It doesn't allow the dollar to gain any real traction in a recovery move. So if risk appetite does continue to improve with how economies are reopening and how the central banks are still on this accommodative stance, then that's going to drive the risk rally. And I think that has the potential for benefiting, obviously, the commodity currencies. We always seem to be happy about how the Aussie is performing at the moment. Yeah. And to the negative side, obviously, that means that depressing the yen and the dollar.
Yeah, agreed. And then obviously, though, we've got these kind of caveats, we've mentioned before of we are coming out of lockdown. You mentioned it there. Do we get that second wave? That's going to be a potential real concern. And then the other thing to note is, data's becoming a little bit more important, right? We kind of forgot about data for a few weeks. Yeah,
May data. I mean, we're starting to see a little bit of a bottoming in the May data. The German ZEW the other day was a fine case in point. And we're also seeing, obviously, the risk appetite coming in through these moves through the EU Recovery Fund, which is starting to sort of generate potential for the coronavirus bonds to come in. So I think that is important for risk appetite this week. Okay, so thanks, Steve. We've had, again, as ever, lots to talk about, and we'll be talking about again lots more next week. So thanks a lot, Steve, and I'll speak to you all soon.
Thank you.